Hey everybody, welcome to this free edition of our Trader User Group Weekly Roundup for the trading week ending September 13th, 2024. I'm Preston Brent, and thanks for tuning in. Well, the theme this week is the time has come. The time has finally come. We're going to get the Federal Reserve probably cutting their rate this Wednesday. Well, not probably. The markets are forecasting 100%, but no such thing as 100% in the markets, but close to it. The only question is it going to be 25 bips or 50 bips? That's a quarter of a point or a half a point. What will they do? Well, if we take a look at this past week and just see how the week fared, you can see everybody solid in the green for the week, a real big bounce back, solid recovery from the previous week's steep losses. In fact, the prior week, the index suffered its worst weekly decline since March of 23. Okay. But the current market narrative has shifted to the Feds being behind the markets in terms of slowing growth, while just 9 months ago, it was viewed as Feds were behind in containing inflation. So how quick things change. We saw this past week, stocks initially headed sharply lower following news that the core inflation, that's less food and energy, rose to 30 basis points in August, a little bit higher than the consensus. Meanwhile, inflation headline showed it came in at 2.5%, well below July's 2.9. So that's the lowest level we've seen in headline since 2021. And the markets did a huge reversal on that day. And the average rate for the 30-year fixed mortgage, with inflation coming down and the odds favoring a rate cut or multiple rate cuts, the 30-year mortgage came in now at 6.29%. That's the lowest we've seen in the mortgage since February 23. Okay. A year ago, it was at 7.21%. Okay. Now, we also see here, you can see the PE ratio still very elevated at 22.68. The markets are richly valued. The 10-year Treasury has come down to 3.65%. Earnings yield 4.69. You can see the VIX came in dramatically this week. It fell 25% for the week to round out the week at 16.56. You can also see the best performer for the week was the worst performer the prior week. Utilities up 8.1%. Energy just bringing up the rear barely at 49 basis points below zero. Utilities leading the way for the year at a very robust 26%. Energy bringing up the rear at 3.74. Okay. As I said, the markets are split right now, 50-50 on whether the Fed's are going to do a 25 or 50 basis point rate cut this Wednesday. The futures market, as a reminder, are pricing in 100 basis point cuts before the end of the year. Okay, so remember, we only got 3 more Fed meetings. We got one next week, we got one in November, and one in December. That would imply the Feds are going to forecast to cut at least one of those 3 times 50 bips. I'm not sure if I see that. I see 3 rate cuts. I don't see 4. The market's going to probably have to come to terms with that this week when the Feds meet, in my opinion. Now, the current Fed funds rate is at about 5.5, 5.25 to 5.5. The current rate of inflation is about 2.5%. So basically, the difference is a little over 2.5% between the current Fed fund rate and inflation. So that gives us a huge, very restrictive economic policy. So it's going to put pressure on the Feds to cut, but I still believe they're not going to cut 50 bips this coming week. I would look for the markets to move up into the rate cut and then pull back after the rate cut for a week or two, right? If we come over here and we look at Europe, you can see the ECB, they did cut this past week. They cut 25 bips. Now their rate's at 3.5%, which is in line with expectations with the market. All right. Now that move came amid signs of further weakening of economic growth across Europe, while inflation is still coming down. Although the ECB came out and did one of their standard statements, which boom, boom, Powell with our Feds do as well, cautioning that they're not pre-committed to any particular rate path, right? Meanwhile, over in Great Britain and the UK, their economy was unchanged for the second consecutive month in July. And we did see manufacturing output contract a little bit. You can see everybody was in the green for the week across Europe. Euro stocks, FTSE, CAC 40, DAX. CAC 40 is the only index in Europe that's in the red year to date, major index. All right. And of course, if we go over to Japan, you can see they were um, up 49 bips for the week, over 9% year to date. Bank of Japan is forecasted they're going to raise their rates again, um, basically coming from comments from the one of the board members on the Bank of Japan. Right, they basically said that short-term rates need to be raised at least to around 1% in the second half of their projected period, which runs through fiscal 26, to maintain and curb upside inflation. Remember, they've been in a deflationary spiral for 2 decades, and they've been trying to get inflation higher by putting a ton of stimulus out there. Now, they're slowly coming off their negative interest rate policy. And as those of you guys know in this free weekly update, I've been encouraging long yen for about 4 months now. It's still a great trade. On the economic front, Japan, their Q2 GDP was revised lower, and it came in at 2.9% quarter over quarter. They were expecting 3.1, but it came in at 2.9. CPI also rose 2.5% year over year, slowing from the previous month's 3%, but it's still higher than they would like. Their consensus was it to come in at 2.8%. And then, of course, if we go over to the Chinese markets, you can see China, again, down for the week. Hang Seng as well. China's down over 7% year to date. The CPI did move up just a little bit in China to 60 basis points. And that was from the prior month of 50 basis points, but that was still below economists' forecast. So the other thing is their PPI fell 1.8% from a year ago, lagging forecasts and deepening from July's 80 basis point drop. Okay, so they've extended their deflation in their factory gate and manufacturing prices, which really started in late 2022. Okay. Meanwhile, exports are exceeding forecasts, meaning that the U.S. and Europe is still on a buying spree. And China loves that. However, their imports are expanding at a lower than expected rate. Okay, that shows the Chinese consumers not spending like they normally do. So China is exporting deflation to Europe and the U.S. So that is helping our numbers just a bit more than normal. Okay, what I'm going to do is I'm going to shift the screen over. Let me just take you to the charts real quick. Give you a real quick update on what I'm seeing here. It'll take about 10 seconds to come on the screen. What you're going to see, though, is the E-mini S&P 500 futures, and it's on a daily chart. Now, you see this gap here. This was a changeover to the December futures contract. That's why it gapped up. My target is up around 5,800. And then I think we're going to have a pretty good little pullback in the October-November timeframe. All right, which implies that we still got some more upward momentum to go before we do hit my target area here. Now, this is for the futures. The S&PX, my target is around 5,700. Okay, but for the futures, it's a little bit higher because we're running a DECE contract, and the December S&P 500 futures contract is a little bit higher than the current SPX cash index. Okay. So you can see where we're sitting right now. This would probably end the Elliott Wave 5 move higher, give us a bearish divergence, and then we'll come in and move lower. We're still not at all-time highs, which were made back on July the 12th. Okay. If we come in here and we look at the Dow, if we take the Dow, you can see here we did make new all-time highs in the Dow. I got to adjust it. And that was made on Friday the 13th. I do believe the Dow is also going to be running into some trouble up here shortly, and we're going to see a bearish divergence on the Dow on this Elliott Wave 5 and then a rollover from them as well. And then, of course, if we look at equal weight, where it's value, you can see the equal weight is moving back up. I think we're starting to see some of this rotation in the market to healthcare and obviously utilities because they're leading the way nationally. They're the strongest sector ETF right now. through almost 3/4 of the year, right? 3/4 of the year. So we're seeing this move up very strong on the equal weight. If we look at the Russell, another one that moves strong along with the Dow, you can see the Russell, it's finally moved back above the 50 EMA, moved up strong. It's going to run into trouble a little bit higher, but I don't know if small cap is still ready to get strong, because if we do have a slowing economy, even with interest rates coming down, small cap is going to suffer. And who's going to win are large cap cyclicals, or defensive rather. That'd be healthcare, staples, utilities, as I said. And let's not forget real estate. I've told our members that home builders is a good place to be. In fact, I picked a few out for our members, and the ones that took the trade did very well. All right, and then finally, if we look at NASDAQ, it brought up the rear on Friday. You could see the NASDAQ, though, just gapped up. Again, December futures contract, but prior to the gap, we're still above the 50 EMA. All right, so I think we're going to start to run into some issues up here because it's very richly valued. And a lot is going to depend on the Feds this coming Wednesday and what they do. Very, very important. Whether they do 25 or 50 basis points is going to, in the long run, it's not going to matter. But short term, over the next month or so, it'll probably put pressure on the equity market. So let's see how this thing is going to shake itself out. Meanwhile, if we come down here and look at treasuries, or we look at the 30-year bond, you can see here the bonds. Also, I got a market is at or slightly above highs for the year. Remember, when bonds move higher, interest rates move lower. But we're setting ourselves up for a poor man's bed, a bearish divergence, but we've had multiple crosses. That means interest rates will probably go back up a little bit, which is signaling to me that the Feds are probably only going to cut 25 basis points and not 50. Okay. And then, of course, if we come down here and look at currencies, if you take a look at the dollar, it's just a low-hanging fruit trade. It's going to come down, take out these lows down here. My target for the dollar is back down around this level down here, right like that, right in that area right there. And then we're going to find some support. It may move a little bit lower than that, because as interest rates come down, the dollar is going to get weaker. And what gets stronger? The euro. And if we look at the euro right here, you can see the euro. It's a nice dip. I think the euro is going to move higher. My forecast for the euro is right up around $1.12, $1.13 to the dollar before we end this year. My favorite trade, my favorite currency trade, is the yen. If you look at the yen, remember what I was telling you guys that are watching this video, right over in this area here, I said go long the yen. Long term, go out 6 months on ratio diagonal spreads, and you could see this thing has just taken off, just been a home run trade. My target, upside target, in fact, was, let me just see if it's in here. I may have deleted it. I'm not really sure. No, it was. My upside target was right in this area here, but you can see these Elliott wave counts are suggesting it can move even higher. So we like the yen to the upside. If we come down here and look at energy or metal, we also like gold to the upside. You can see gold made a new high on Friday, up 26.2% on the 13th of September. But I like, and I told our members, I like silver over gold, right? The ratio of silver to gold is really wide right now, meaning it takes more ounces of silver to make gold, right? You can see gold had made new all-time. I mean, silver has not made new all-time highs. So I like a pair trade, going long silver and short gold. Do it in the right ratios. Members, we'll set up an option masters on how to do some really good pair trades. Silver and gold's a fun pair trade to do, like WTI oil and Brent crude. And speaking of Brent crude, or WTI, let's go look at oil. Oil came down, hit my target down here on September the 10th. That was my target. And then I think we're going to bounce around and slowly slide a little bit higher. You can see there is no divergence in here, so that does suggest that any rise is subject to another retest of this area down here. But this is a good area to for options traders. Vol is a little bit higher, but it's a good area to put on some trades. Members, we'll talk about it in our Sunday night weekly market watch. That's pretty much well. One other quick thing, and then I'll end our weekend session. Nat gas. Nat gas is moving up as we go into the end of the summer months. I've got a target here for nat gas to come back down. If we can get a little bit lower, then I'll be more interested in long. Right now, we're just barely having trouble getting over the 200 EMA, that yellow line. I would much prefer nat gas to get much lower before I enter a long position. Right here, I'm neutral on nat gas. It's neutral to slightly down. All right, everybody, have a great weekend. Enjoy college football or pro tomorrow. Members, I'll see you Sunday evening for our weekly market watch. Take care, folks. Ciao now.